been an interesting year. I mean, the year started with us having sort of a little bit of a COVID overhang still, but we were on the front foot going into the year, and I think our credit origination strategies, our value propositions, our digitization journey and agenda, and then also we added the new brand and a new focus on how we do integrated advice and helping customers with their sort of broader financial needs, not just individual products, but how it fits into their lifestyles and their businesses. So it's been a good year, and very grateful for our customer support through the year.
Talk to me about that credit origination strategy. What has been the approach, especially when you look at it from the retail side?
Yeah, what's nice about having a transactional banking relationship with customers is we're really able to sort of pick and choose how we build our balance sheets. And that's both in the retail side and the commercial side. And clearly, when you have got a nice relationship with a customer for multiple years, we know more or less their credit behavior, we know where the risks lie, we know their stability or not of the income, and then we can personalize value propositions to them and price it appropriately. And over the last year, that certainly continues to be the direction of travel for us as we focus on building our value propositions and our customer base into pockets of the economy that have a better viability and are able to deal with the ups and downs of the cycle and whatever markets bring us. So we're very grateful for the positioning that we've been able to achieve with all of our efforts.
It's been quite interesting having a conversation with a number of your peers out there, especially when we unpack the NPLs. From your side, what's driving NPLs? Where are you seeing the pressure?
Yeah, I mean, I think if you had to go back at the current NPL range, clearly are not things that you originate today, right? They were things that were originated a year or two ago. We were quite conservative in that 2020 year. We were focused on our existing customers, getting them through COVID, but we weren't building new relationships and taking on new risks that we weren't aware, that we weren't, on top of, and especially as it related to people with being first time in credit, low interest rates, many people rushed in the market. So we were quite cautious in that COVID year. And then 2021, we became what we refer to as a sort of spring season where we got a little bit more front footed. In 2022, we built into an additional credit appetite. And I think that stood us very, very good because today, many of the NPLs people would be dealing with are things that they originated 2 or 3 years ago. So that's important. And then clearly looking forward, we've got the same agenda. We are originating very little credit in high risk categories. We are very, very cautious and looking for opportunities in segments like in the commercial sector where some sectors of the economy are doing well, and other sectors are doing a little bit less well at the moment. And so that balance to get the portfolio structured correctly is very helpful in playing out, that thesis is playing out in our business at the moment. You must expect a bit more NPLs as the market deteriorate from here. The higher interest rate clearly has had a big impact. The low growth has had a big impact, but our business very well positioned. Our balance sheet strong. We're ready for what we think that will be a bit of a uptick in our CLRs, but nothing untoward. And we, as I say, we're well positioned.
When it comes to client growth, in which segments are you seeing it? And given this background that we've been talking about for quite some time, are you confident that you can sustain it?
Yeah. I mean, the last year has been a very exciting growth year for us. If you think about, we started with refreshing our brand. We put new platforms and digitization and payment innovations and the ways of communicating our customers. So our value props are relevant, they're fresh. We've got a build out of our insurance businesses, a build out of our invest businesses to be able to help clients through, navigating their financial consequence. And I think this is a very good time for us. Our customer base are really resonating with our value props, and we continue to gain market share from our competitors. So we hope that we can sustain some of the growth. What's nice also with the way that we're packaging, the execution is that it's coming in a much more efficient way because we're leveraging our platform and our data capabilities a lot more to be personalized with value propositions and tailor them, based on behavior. And as I say, I think that will still stand us some good stead to grow further for the year.
I'm curious, when it comes to the higher for longer narrative as it relates to interest rates, do you think we've reached peak interest rates? And are you expecting possibly even a cut next year? How are you seeing things?
Yeah, I think it's definitely at its peak, and whether it's this quarter or that quarter of starting to give us a very breathing space. We're obviously dependent on what happens around the world, but we're grateful for how the regulators have managed this, and so it's really played a big part to get us, I guess, on top of this inflation risk that could really become a problem. But it's going to be hard out there. I mean, it's not the time where any of us should be positioned for magic. It is what it is. The economy is tough, and we're a big business. I mean, what you must expect of our organization is really trying to lean into the market, right? If a third of the country's economy runs through, a group like ours, and if you pull back, you obviously, take oxygen away, and if you lean in, you add oxygen. So we hope that the market sees us as participating, as front foot, as trying to look to stimulate the economy and growth opportunities that our customers have got, and we'll see if that plays out with sufficient support for the market.